The first thing we need to do is reevaluate our lease classification, and this should be fairly simple. The lease still does not pass ownership at the end of the lease term and provides us with no option to purchase the van. It also still is not a highly specialized asset. Now, for the test of whether the lease term at this point covers a major part of the remaining useful life of the asset, we're getting a little bit closer. We have almost 2 years left in the lease term for a total of 5 years. The van was new when we leased it, so at that point it'll be 5 years old. This depends on our estimate of the total useful life of the van, which we'll assume is 7 years. In that case, as of remeasurement, our lease covers roughly 50% of the remaining useful life of the van. We have a 23-month term, very close to 2 years, and a 4-year remaining useful life. This falls short of the 75% threshold, so we failed this test. The last remaining criterion is the present value of the lease payments, and we perform the same analysis at remeasurement as we do at commencement. Let's assume that on this date, our analysis suggests the fair value of the van is $29,000. The present value of our future payments at this point is $25,676. Which is 88.5% of $29,000, short of the 90% threshold. So we fail this test as well, which means our lease will remain an operating lease, and we can now fill that in here. Now the only things left to update on our schedule are our right-of-use asset and lease expense. Based on our new right-of-use asset schedule, we clearly have an issue. To begin, we need to set the opening right-of-use asset balance to what we've calculated, so we'll link back to that. And then in this opening period, we'll have no amortization of the right-of-use asset, so let's hardcode that as 0, just as we do on our new lease schedules. And now we need to recalculate the total lease expense over the remaining lease term, which we'll calculate as the total lease payments over the entire lease term, plus any prepayments to the lessor and initial direct costs, less cumulative expense we've recognized immediately prior to remeasurement. So in our operating lease expense, let's clear out the calculations. Then this first line will be the total lease payments over the entire lease term. I think the clearest way to calculate this is to add a total row to our schedule that sums up everything, including the pre-remeasurement information. So let's do that now. We'll call this lease totals, and then simply sum up the entire schedule for each item. Now back in our operating lease expense, we can link to our total lease payments over the entire life of the lease. Then for our prepaid lessor payments, we'll link back to these on our archived lease schedule. And same with the initial direct costs, which are just the row below, so we can copy this down. Then for the final item, we need to subtract off the lease expense we've already recognized. So we'll add a row, call this previously recognized, and the formula will be negative, and then we'll link it to the cumulative lease expense immediately prior to remeasurement. And then finally, we'll update the total to post-remeasurement expense and sum up all 4 of those items. And now you can see we're once again amortizing our right-of-use asset to 0 by the end of the lease term. And if we update our check, the lease expense can be found in our last row, and same with the total cash payments. And there we go. We now have our remeasured lease schedule, and we're set up to enter our remeasurement entry and perform our subsequent accounting. So let's go make that remeasurement entry now. Here we have our balance sheet as of July 1st, 2029, the remeasurement date. And if we just quickly look at our vehicle lease balances, here you can see our right-of-use asset is $13,005. The current vehicle lease liability balance is $13,936. And we're within 12 months of the pre-remeasurement end of the lease term. We no longer are at this point because we've exercised that renewal option. but we were before remeasuring, so we have no long-term liability balance. So now let's go create a journal entry to remeasure our lease. This will occur on July 1st, 2029. And we know the overall change in our liability will be a credit to increase it by $11,739.06. The only complicating factor here is the current and long-term breakdown. To keep this simple, we'll completely clear out the liability balances by debiting the values as of remeasurement. And then we'll credit for the new opening values we've calculated. So let's clear them out first. This will be a debit to vehicle lease current, and the value currently in that account is $13,936.48. And there was no long-term value, so we don't need to do anything there. Then we'll record our post-remeasurement opening liability balances. First, we'll credit our vehicle lease current, and that we calculated as $13,208.42. Then we will credit our long-term liability, and that we calculated as $12,467.11. And then finally, we need to offset the change in the liability to our right-of-use asset, which will require a debit of $11,739, and here you see 5 cents instead of 6 cents. That's because in our accounting system here we're rounding to the penny, while in Excel we are not, so we'll leave that as is, and we can save and close. And now you can see immediately post remeasurement, here's our vehicle right-of-use asset balance of $24,744. Then we have our current vehicle lease liability balance for $13,208. And then here is our long-term vehicle lease liability balance of $12,467. All of which match the opening balances we calculated for our remeasured lease. Now let's look at our subsequent accounting journal entry. First, let's update the identifier here to 6.1. And since we only updated the worksheet name, the formula references should remain correct. So just to highlight this, let's sum up our operating lease expense for the period. You can see that on the reporting date August 31st, 2027, which is before our remeasurement, our operating lease expense is $1,206.25. And if we look at our original lease schedule, that's what we had originally calculated for our straight line lease expense. Now if we update to, let's say, August 31st, 2029, after our remeasurement, you can see our straight line operating lease expense for the remainder of the lease is now $1,110.28, which is exactly what we've calculated here on our remeasured schedule. And if we just update this to the next month, September 30th, 2029, you can see our operating lease expense remains that straight line amount of $1,110.28. So let's actually change our reporting date to July 31st, 2029, the first reporting date after remeasurement. And now the process to record this subsequent journal entry is identical to what we've seen in the past. So I know this has been pretty dense material, but we've now covered lease remeasurements in detail. We first looked at the theory under ASC 842. And then at the practical steps to account for a remeasurement in our workbook. And at this point, we're fully set up to account for our remeasured lease going forward. In the next episode, we'll continue this discussion by looking at lease modifications. The good news is that the new accounting we need to cover for modifications is fairly simple. Modifications fall into one of two paths. Either we have an entirely new lease, or we perform a remeasurement. And we've already learned how to account for both. The only additional complexity may be terminating an existing lease if the modification results in full or partial termination. So let's begin looking at modifications in the next episode.